Hey, I'm Jason, and this is Supply and Demand Daily, where I tell you what we learned about the economy today. I'm wearing black today, and why am I wearing black? Well, I'm in mourning for life affordability, and there's two reasons for that. For one thing, I filled up my gas tank yesterday, and that was just completely awful. And another thing, the Bureau of Labor Statistics released its Consumer Price Index data for May of this year, and wouldn't you know it, inflation did not peak. Prices between May of 2021 and May of 2022 went up 8.6%. So that is the annual inflation rate that we're looking at now. Why does my face itch? That's just the worst timing app. Anyway, but the other thing we're going to talk about is we're going to go into the details there. And then the other thing we're going to talk about is how the bond market responded to this news, because it was a bigger jump in the change in bond yields than I've seen in response to any of the inflation news that we've seen in the last year. So that was definitely interesting. And then the consumer sentiment index is still just at rock bottom levels. So I want to cover that as well. And in order to do that, I'm going to go ahead and get out of the way, and we'll go ahead and get started. So inflation, that is the broad consumer price index, is up by 8.6%, which is the highest level recorded since 1981. So we're looking at 40 years here, and we're bumping into a place on the chart that I'm going to go ahead. Well, I'll just go ahead and show you now. So this is a long run chart of annualized inflation rates going back to 1941. And this level that we recorded today puts us all the way back at, like that headline said, 1981 levels, but these are levels that we saw in the Great Inflation between 1965 and 1981, when it finally ended, or maybe roughly 82. And so that's why these inflation readings are so significant, is because we just have not seen much of that at all in the last 40 years, with the exception of these oil price driven spikes here in the mid to late 2000s, right? So 2005, 2007, 2008. And so that's why there's a lot of talk about this, and why that's why it's so important. And well, it's also important because it's literally a decline in the relative wealth, or the decline in the relative purchasing power of everybody. So everybody faces this, basically this hidden tax on society, and so it's very important to kick this thing. But before I get in too much of a ramble there, so core inflation, that is the consumer price index, but removing food and energy prices, so not including those things, just all of the other stuff. And the reason that that's done is because it's thought that food and energy prices are more volatile, so that they should not be involved, or should not be included in the index. But anyway, so core inflation was also up 6%, which was a surprise reading as well. It was greater than all the forecasts among the industry professionals, so or among economic forecasters. And from April to May, so there's two ways of looking at inflation. You can take the consumer price index today versus the consumer price index 12 months ago, and that gives you the annual. But then you can also take the monthly percentage change, which I think is even more important, because that shows you what the trend is right now, what's going on right now, or what was going on a month ago, as late as we have data available, right? So that was up 1%, and that doesn't sound like a lot, but to compare it to annual rates, you just multiply it by 12. So that's an annualized rate of 12%, at least if you annualize it one way. And then for core CPI, that was high last month as well. That was very high in May relative to history. That was 6.3%, so more than 0.5% in that 1 month, which is pretty darn crazy, especially because a lot of people and analysts and professionals have been saying over the last several weeks that inflation has probably peaked, like Paul Krugman, for example, an economist who writes for the New York Times. So, and then this is just going to give you a visual representation of what the consumer price index is made of. We're talking about a weighted average of the prices, of the price changes in stuff that people spend their money on. And so Shelter makes up about 32% of the index. Food is about 13, transportation is about 10, and energy is about 8. So that just wanted to give you a visual idea of how all that works. Now, I already showed this chart, but one thing that I wanted to explain about it is that this is a 3-month annualized rate of change. And this is, like I said, it's good to look at the monthly percentage changes because that tells you on a current basis what the underlying pace of change really is, because there are certain things that can happen over the course of a year that can distort that annual number and make it appear like either more or less than it actually is. This is an example of an inflation report where it was actually true that both the annual rate, that 8.6, and the monthly rate, month over month was 1%, were both really, really high. But that's not always the case. A lot of times the annual can distort the monthly, or the monthly can distort the annual. Well, really the annual is the most susceptible to being distorted, so it's important to look at the underlying monthly figures. And what this 3-month annualizing method does is it takes the average of the last 3 months and simulates what it would be like if an entire year were like that. So you take the average of the last 3 months and multiply it by 12, you get 3-month annualized. And what I'm showing here is that we are significantly higher than most of the time in the recent history, the recent 40-year history. There were a couple of times in the mid to late, or in the early 2000s, when we got about up to this point. And what we'll see when we look at the other form of inflation that we're going to discuss is that most of that was driven by oil prices. But then, broad-based, the only other time in history, at least recent history, that we have seen these rates is, in the post-war inflation of the late 1940s and early 1950s, and then in the Great Inflation between 1965 and 1981. So just some perspective there. And then so if you take the 3-month annualized rate, we're currently sitting at 10.2%. Average the last 3 inflation rates on a monthly basis, multiply it by 12, you get 10.2%, which is pretty insanely high. And then if you look at the core CPI, which most people, who are familiar with these would typically think to be lower, well, that is definitely the case. This does not include food and energy prices. And what you notice is that if you look at core CPI, if you look at core consumer prices, the rate of change in there, that pretty much erases this inflationary spike that happened in the early 2000s. It went up a little bit, but just not by much. And just to compare, one more time, we're talking about these kind of spikes versus these kind of spikes. Not all that consequential. And so it's really, I do think it's important to look at the core CPI as well, but, we have these changes and we have this inflation rate that was only seen, back in the late 1980s, and then, and before that only seen during the Great Inflation. So that's why this has been so front of mind, and why it is, why Americans, when politically polled, when they're asked what their top issues of concern are for politics, they talk about inflation. That's topping the list in the more recent Pew polls above everything else that's going on. So now I want to talk about the monthly percentage changes by category. I just want to go through them. The top gainers in this area are just some of them that I wanted to call out, because undoubtedly you probably won't be able to see this text. That was the size I had to make it to be able to fit it all into the chart, or fit it all into the slide. We have fuel oil going up by 17%, and this is in a single month. All right, this isn't year to year. This is a single month. So food oil going up 17%, airline fares going up 12.6%, utility gas service 8%, and then energy commodities in general going up 4.5%. Then you got food at home. Looks low because, in comparison to this stuff, a lot of things would look low, but food at home going up a full 1.4%, which actually reflects the same kind of phenomenon that we saw in the Adobe price index, or the Adobe inflation report that was released yesterday that I talked about in yesterday's video. and that showed that there was a lot of spending getting diverted from discretionary stuff, your electronics and entertainment and going out to eat and stuff like that, into the stuff that you have to spend money on, basically food and shelter and energy, whether that's in transportation or electric bills, right? So pretty big changes there. And then the one category that did not actually pick up in price at all, there was only one on the list, was physician services, ironically enough, because I think most people are aware that healthcare seems to get more and more expensive at a much higher rate than all other prices, but physician services went down 0.3% in May. Big relief there, but that was the only category that was below zero, and it was also the only category that was below the Fed's target of an annual 2%. So the Federal Reserve has a credibility problem, just something to touch on here. Back in September of 2021, if you're not necessarily somebody who pays attention, back in September of 2021, we had about 3 to 4 months of high inflation readings, and the Federal Reserve Board and the chairman of the Fed was still saying that these were all due to supply bottlenecks in supply chains that were caused by the COVID-19 pandemic and, of course, the response to it, and that they would be turned around eventually. And then there was in that meeting that this press conference came from, the Federal Open Market Committee. These are the people who are in charge of setting the money policy essentially for the national economy. Well, they forecasted that over the average inflation rate for 2021 would be 4.4% annualized basis, and then in 2022 it would be 2.2%. Now we're sitting here, it's June, and the average annual inflation rate is 8.1 on a broad base, so that's the consumer price index with everything, and 6.2% on a core basis, so the consumer price index without food and energy. So they definitely have a credibility problem, and I think if I'm stepping into the minds of these folks, I think that they really, really need to show the political, they need to show the people of the United States, and they need to show the political class, that is the people who occupy elected offices, that essentially they mean business. So what they're doing is essentially to look like they're doing something about inflation, and the way that they're doing that is by raising their short-term interest rate, the federal funds rate there, which is their primary interest rate that they set in order to sort of manage the monetary situation in the economy, the money situation in the economy, the growth rate of credit in the economy, which ultimately is what drives inflation. And so to dive a little bit deeper into that, this is related to how the bond market responded to the inflation news today. We got a pretty big surge in bond yields, and I touched on this yesterday, but when it comes to viewing a chart of bond yields, you can think of the yield as a rate of return on a type of a bond. And a bond is just a loan either to a corporation or to a government. Essentially, that's what a bond is. Its terms are very different to the kinds of loans that you take out on cars and on houses, so that's why they're called bonds instead of loans, but that's essentially what they are. They're just loans. And there are loans that you can sell and buy from all sorts of different counterparties. So you may not be able to sell your own auto loan or, somebody else's auto loan, but if you take a loan that's been made to the United States government, somebody will probably buy it from you. So that's kind of how that works. And when you look at a chart of bond yields, essentially what to keep in mind is that up means selling. So it kind of means the inverse of what you might think it means. Yield is the inverse of price. And so when you look at a chart like this, you say, okay, the yield is going up. The way to interpret that is that there's more selling, there's more pressure to sell than there is pressure to buy. So that's what's going on here. And then if the yield goes down, that means there's a lot of buying in that particular particular type of security. And by security, I just mean financial assets, some kind of like a stock. A stock is a form of security, okay? And so we had a pretty large surge in bond yields. This dark blue line is the 10-year Treasury yield, and then the orange line is the 5-year Treasury yield. And when we talk about Treasury, we mean U.S. government bonds. And then the blue line is the 2-year. And they all went up quite a bit on this inflation news. And why might that be? Well, I don't want to get in too much into the dangerous business of crafting a narrative out of every single change in prices, because there's a lot of randomness in prices that there's not really a whole lot of rhyme or reason to. But in this particular case, it could be an adjustment of expectations of what the Federal Reserve is going to do with its short-term interest rates that it sets and that it regulates. Okay. So that federal funds rate is part of the spectrum, or part of the curve of interest rates, and that essentially has a large effect on the value of bonds. So whenever interest rates rise, the value of bonds, or the prices of bonds, go down. And I'm showing that here in this chart. So on the left-hand side, we have the price of a 10-year bond, and then on the left axis, on the x-axis, we have, couldn't find that word, or that letter. On the x-axis, we have the prevailing market yield, so the prevailing market rate of return on 10-year securities, on these 10-year U.S. government bonds. And then this line shows you the relationship of what happens to the price as the yield rises, as the market yield rises. So, and specifically, this is a bond that pays 1.5% interest, and so that's different from a market yield, and I'll probably do a video just explaining that here in the near future. But what you need to understand is essentially that if this bond is $1,000, so if you buy $1,000 worth of a bond and it has a 1.5% coupon, that means that you're going to receive $15 in interest every year that you hold it. And then the market yield just depends on, people buying and selling bonds. That's where that comes from. And so what happens, as you can see, I just wanted to visualize, is that when you start here at 0.5%, so 0.5%, that's your rate, and we're going all the way to 3.5%, you start at a low yield and you start at the highest point up here and you finish down here. So just this change in market interest rates or market bond yields brings the value of this bond, or can bring the value of this bond down by, I think just short of $300, if I remember what the math was. And so I just wanted to show you the effect there. Now, the Fed has a credibility problem, as we already established, and it needs to show, in order to undo that credibility problem, it needs to show that it's fighting inflation. And so a higher reading of inflation, a higher inflation number, implies that the Federal Reserve is probably going to have to hike rates. It's going to have to raise their short-term interest rates a little bit faster, because that is their lever, that is their tool for fighting inflation. And so what that means is that these types of financial securities, these 10-year, 5-year, and 2-year government bonds, well, the value of those things is at risk, because the Federal Reserve is going to raise its one-day interest rate. The Fed funds rate is a one-day interest rate. It's going to raise that interest rate, and then a lot of other rates are going to go up along with it. And then these types of securities are not going to be worth as much. These types of bonds are not going to be worth as much. And so that creates an incentive to sell, and then the yield rises. So that is the thinking behind that. And not everything is attributable to that kind of narrative, but I think it's a pretty good explanation. We had a big surprise inflation print, and a lot of people sold their bonds. Kind of makes sense. So moving on from that, though, that's pretty much all that I wanted to cover about inflation. Now we'll get into the numbers on the Consumer Sentiment Index published by the University of Michigan. Last month, last month's release, which would have been for April, they were definitely very, very low. And here we are sitting in June. We're looking at the consumer sentiment for May, and it definitely reflects that prices were increasing at a really high rate. Personally, I know that everybody is feeling the pinch of gasoline, and a lot of people are even feeling the pinch of new electric bills as their fixed rate energy contracts are repriced and they have to renew them. So those rates are going to go higher as the price of natural gas increases. And so everybody is feeling the pinch of inflation, and the consumer sentiment index definitely shows that. There was a great deal of energy prices increasing in the, like I mentioned earlier, the 2006, 2007 into 2008 as well. And we saw a similar pattern where consumer sentiment really dropped off of a cliff during that time. And that, as you may either remember or may have read, culminated in the Great Recession of 2000, or, really the financial crisis of 2007, which led to the Great Recession of 2008, 2009. And so the percentage drop in the consumer price index was actually 10%, which is one of the bigger ones, one of the bigger drops over the years. If you take all of the rates of change and just compare them to each other, this goes back about 70 years. So this University of Michigan consumer sentiment index goes all the way back about 70 years, and it's based on directly surveying consumers. So it really tells you, really gives you an average of how American consumers are feeling, and it tends to be a pretty good predictor of economic troubles being ahead. So, and just for comparison's sake, what this orange line shows, and this is basically we're sitting at the same level as where we were at this orange line, and that is September 2008, which is when the massive investment banking house Lehman Brothers collapsed. It couldn't take on any more loans because no one would lend to it, and it had a bunch of obligations that it could not pay, and the whole company went bankrupt, essentially went up in smoke. And unlike Bear Stearns, it was not saved by the Federal Reserve. So we're sitting at a level that is as low as what it was during September of 2008 when all of this happened. So definitely not a good sign there. And then just to drive that point home, I have a histogram of the rate of change of the consumer sentiment index from month to month. The way that a histogram works is it plots all of the, so we're talking about rates of change here, so all the rates of change over the last 70 years, it's going to take that and put it in buckets based on how much the number in a particular interval appears. So to give you an example, this interval right here is negative 2% to 0%. So a negative 2 to 0. And this is telling you that over the course of that 70-year data set, there were about 130 instances where we saw where we saw a rate of change from month to month in the consumer sentiment index that were between 0 and negative 2%. This is where 10% falls. So there were, fewer than 10 times in the last 70 years when there has been a negative 10% reading on that consumer, or a negative 10% change from month to month on that consumer sentiment index. So this, gives you a gauge of where you are, a visual gauge of where you are relative to history. And so I always find it, some histograms are not appropriate for everything, but for some types of analysis, they certainly are. And I thought that this would be one of those times. So that shows you where we are with that particular metric, that University of Michigan index. So with that, I'm going to go ahead and sign off. I'm at minute 22, 23, which means I'm way over. But I hope you enjoyed this video. If you have any feedback as to how these can be done better, do feel free to let me know. And I hope to see you on Monday for another episode of Supply and Demand Daily. I don't know if it's appropriate to call it episodes, but whatever. See you back. Hope to see you back here on Monday, and I hope you have a wonderful weekend, and good luck, because inflation sucks, and I definitely feel it. I know you do too. So, but anyway, take care. I hope you have a good one, and I'll talk to you on Monday. Thanks.